to market strategy.
Hello everyone, welcome to Market Strategies. Today, we are introducing a very safe hedging strategy for those trading in the MCX commodity market, especially in natural gas. This is a strategy that combines futures and options to help you earn decent profits without taking huge risks. We are not just taking a random hedge trade. Instead, this video is prepared in a way that helps you easily understand the mathematics behind it. Today is December 26, 2025. The time is 9:28 p.m. The natural gas January future is trading at 347.80 rupees. Based on this price, we are introducing a collar strategy using futures as the underlying, which can be held until January 22, 2026. Let's look at the entries taken for this hedging. First, we buy natural gas future at 347.80 rupees. Second, to protect ourselves if the market crashes, we buy the 370 put option at 44.05 rupees. Third, to reduce our cost, we sell the 400 call option at 15.10 rupees. Remember, the lot size is 1250. However, before taking a position, natural gas and crude oil traders must check one critical factor: liquidity. We must ensure the strike prices we choose are active. Let's check the liquidity for each entry. For the natural gas future, the bid-ask spread is only 20 paise. You can enter confidently. For the 370 put option, the spread is only 15 to 20 paise. Again, safe to enter. For the 400 call option, the spread is just 10 paise. It has excellent liquidity. Always avoid strikes that lack liquidity.
Now, let's calculate the net debit, which is our actual out-of-pocket cost. Subtract the 15.10 rupees we received from selling the call from the 44.05 rupees we paid for the put. This gives us a net debit of 28.95 rupees. Next, let's define the break-even point. In most hedging strategies we've studied, profit only occurs between two specific points, but this is different. Add the net debit of 28.95 rupees to the future buy price of 347.80. Our break-even point is 376.75 rupees. At expiry, if the price settles below 376.75, we incur the maximum loss. But if it is above 376.75, we are in profit. Let's calculate the max profit and loss. Since we sold the 400 call, our upside is capped. Subtract our break-even of 376.75 from 400, which gives us 23.25 points. Multiplied by the lot size of 1250, our maximum profit is 29,062.50 rupees. Now, what if the market crashes? Subtract the put strike of 370 from our break-even of 376.75. That is 6.75 points. Multiplied by the lot size, the maximum loss is only 8,437.50 rupees. No matter how much the market falls, you won't lose a single rupee more than this.
Please pay attention to the following important points. 1. If the 400 call option had not been sold, this would have been a hedging strategy with unlimited profit potential. However, a smart trader's goal is not unlimited profit, but rather limited loss. 2. If the 400 call option had not been sold, the premium leaving our hands would have been higher. Consequently, the maximum loss would have been above 27,000 rupees. But by selling that call option, our risk shrunk to a mere 8,000 rupees. More important than a large profit is how much you can limit the loss. 3. Another crucial point to remember here is this. If the 400 call option had not been sold, the point at which profits begin, that is the current break-even point of 376 rupees 75 paise, would have changed to 391 rupees 85 paise. Let's see how that is. When we sold the call option, we received 15 rupees 10 paise. If we had not received that, we would have had to add that extra 15 rupees 10 paise to the cost of achieving the current break-even point of 376 rupees 75 paise. So, we would have to add 15 rupees 10 paise to 376 rupees 75 paise, then the break-even would become 391 rupees 85 paise. That means, in such a scenario, we would have made a profit only if natural gas reached above 392 at the time of expiry. However, in the current situation, we enter profit territory as soon as it crosses 377 rupees. This is smart trading. 4. The point that profit comes only above 376 rupees 75 paise according to the break-even is the calculation for the expiry day when the contract expires. By then, the options premium would have decreased due to time decay. But that's not the case with natural gas. It is an asset that can move 5 to 10% in either direction in a single day. Therefore, there's no need to wait until expiry. After we hedge, even if the market moves just 10 points upwards within the next week, you can see a profit of at least 3,000 to 5,000 rupees. That is the biggest speciality of this hedging strategy. 5. If the natural gas price moves up, there's no need to wait for expiry. You can close this position as soon as you see a decent profit. Then, according to the market price at that time, by adjusting the strike prices and creating a new hedge, you can make a profit again. 6. On the expiry day, no matter where the market settles above 376 rupees 75 paise, whether it's 380 or 390, we will be in profit. The profit increases as the market moves higher. It reaches its maximum when it hits 400. Wherever the natural gas future goes above 400, our maximum profit will be fixed at 29,062 rupees. That is, for every point of profit in the future above 400, there will be a 1-point loss in the 400 call option. Thus, the profit above 400 and the loss will keep tallying. 7. There is one more thing about this strategy that not many know, but they really like once they do. Normally, buying a future and selling an option together requires lakhs in margin. However, because this is a hedged position, the exchange provides us with a significant margin concession. It might be hard to believe, but it's true. To take such a large position, you need less than 1 lakh rupees in your account. In this video, we mentioned that even if the market moves just 10 points upwards within a week, we could get a profit of 3,000 to 5,000 rupees. The script for this video was prepared on Friday night, December 26th. On that day, the natural gas price was 347 rupees 80 paise. Today, when this video is completed and reaches you, let's check the market change in real time. Today is Monday, December 29th. Since US summertime is in effect, the MCX market closes at 11:55 p.m. The time right now is 11:34 p.m. With just 20 minutes left for the market to close, natural gas future is trading at 360 rupees 70 paise. That is an increase of approximately 13 points from our entry price. This small change alone shows a profit of 3,235 rupees in our hedging position right now. In the coming days, if the market moves higher, this position will reach the maximum profit we calculated, which is 29,062 rupees. This demonstrates the power and safety of hedging. If you liked this video, don't forget to like and share. Please record your valuable comments and suggestions in the comment box below. To learn such insights about the market stock, subscribe to this channel, Market Strategies. Thank you. Namaste.